64% down from all-time highs. Is Tesla finally at a buy zone? Today we're going to look into TSLA stock to see where it could be headed in the future, what it's currently worth, and assess the financial situation. So we have a price per share of 145.50, a price to earnings ratio of 33.76, down from what I remember to be about 100 price to earnings in the past. They have a market cap of $463 billion and an enterprise value of 433. Looking at their financial strength, there's a cash to debt ratio of 3.04. So for every dollar of debts, they have $3.04 to pay down their debts or expand the business. Looking at the profitability and the margins, we can see not solid green bars, so not doing the best they have. Gross margins currently at 18.25 with a median of 21.9. So between that minimum and median for gross margins in the last 10 years. Their operating margins, they have a median of being negative and a current of 9.19, so solid margins. They currently net the most they have in the last 10 years, so 15.5% netting. So for their revenues, they net 15.5, which is a good signal, something I'm happy to see. And for free cash flow, they're sitting between their median and maximum with 4.5 currently, and that high of 9.27. So realistically, these are fairly low margins, but as of right now, this is just a automobile business really, and the charging stations. So you'd expect lower margins for that type of business because higher costs, etc. I use these to tell me about the business, but for management strength, I use ROE, ROA, ROIC, and ROC. And for return on equity, they have 28%, 28, call it 29%. So very strong in the industry and also very strong against their historical. So management is executing very well. Looks like same story for ROA and ROIC, just about near that maximum, just below that maximum for all these three. And for ROC, still pretty strong. So management strength looks like they're performing very well. With the price to earnings ratio, we can see a solid green bar here. And this is almost the minimum that they've traded for in the last 10 years based on a price to earnings ratio. So currently they have 33.76 with a minimum in the last 10 years of 31.23. So it doesn't look like a bad time to be buying based on their last 10-year price to earnings ratio. Looking at their financials on a trailing 12-month basis, in their most recent quarter, they have almost $97 billion of revenue and just about $15 billion in net income. So to make it easy, call this 115. And here it was roughly 1 to 35. So you can see that the margins have increased very easily. Here's the graph, so it's a lot easier to read it, but that's how I think of it. In the last 4 years, they've gone from being a 1 to 35 profitability type of company to a 1 to 10. And that's pretty impressive, actually, even though these net income and EBITDA bars are fairly flat, even though the revenue is still on the uptrend here. So not exactly ideal, but again, in the last 4 years, they've multiplied their margins significantly, even though the business is trending slightly flat. Cash to debt, great sign. They have more cash than they have debts, and we can see they paid down their debts, even though they're slightly increasing again, but still cash outpacing. Significant share sales, which decreases shareholder value by increasing share float, but it looks like they're slowing down a bit. Looking at their operating revenue by business segment, they make about $90 to $91 billion from automotive and $6 billion from energy generation and storage. So I'm sure in the future he plans to make this a little bit more of an ecosystem to take up a larger moat of this and probably expand into other businesses as well. And we see that their operating revenue by geographic region has 46.7 in the United States, 22.5 in China, and other international with 30.8. So fairly spread out, although heavily weighted, at least for the time being, in the United States. But to see what it's worth, let's run a DCF. Before we do that, if you enjoy these type of videos, make sure you subscribe to the channel and leave a like. If you didn't like anything in the video, or if you disagree with something, let me know in the comments. But as of right now, those are two ways you guys can help the channel to make better content in the future. But back to business. Here we are on the DCF. We have not much data for a 10 or 5-year earnings per share annual rate. And for free cash flow, same story, just in the 3-year average. But that's not terrible news. We can still at least see some estimate. So seeing what's currently priced in for earnings per share. Earnings per share looks to be priced to grow at 27 to 28% annually for 10 years. And in the last 3, it's grown at 144 annually. So pretty impressive growth in the last 3 years. Although 30% is, it's a strong amount of growth to be pricing in for 10 years annualized, because there's a lot of things that can change in 10 years. Not doubting Elon, but that 28% is priced in. So if you want to see a fair value higher than that, you're going to have to see maybe 30, 33, 35. So it all depends on what you think they're going to grow at. But that's a bullish estimate. Let's look at a bearish. If you think they're going to slow down and grow at 24% a year for the next 10, there's an estimate. But looking at free cash flow, so seeing what's currently priced in, they're priced to grow at about 40% annually. Price to grow their free cash flow 40% annually is still a very lofty valuation, but this is just free cash flow. Sometimes it cannot be as accurate, although as an investor, I don't really want to be going after stocks that don't fit all the criteria. If I have 10 criteria, I want the one that's going to fit all 10 or even all 9. So for me personally, I do want to see free cash flow and earnings per share both showing a relatively cheap or even fair valuation. But there's a lot of factors that influence the decision there. So let me know in the comments, are you buying at these levels? Again, based on price to earnings ratio, this is very cheap. Elon can do a lot of things in the future with robots or AI, you name it. Whatever he wants to build this brand into, I'm sure he will do something incredible in the future. So am I buying at these levels? We'll have to see. But I'm definitely keeping an eye on it, because it's one of those companies that you just really can't. A DCF doesn't tell all the numbers or all the data or the bigger picture and the vision. So that being said, this is my take on Tesla. See you next time.